Hi, I'm Tom Lydon, editor of ETF Trends, here in Hollywood, Florida at the Inside ETF conference. I'm here with Mannik Dhillon, who's the head of investment solutions for Victory Capital. Great seeing you, Mannik.
Thank you for having me.
So, Smart Beta strategies is really something that Victory's working on. Tell us about your unique approach. It's quite different than everybody else.
We do, you're right. We have a unique approach at alternatively weighting traditional cap-weighted indices. So Smart Beta, if you think about it, has to improve upon some outcome that cap-weighted has provided for years and at lower costs. Volatility weighting, what it strives to do is use one of those well-known factors, not as a selection mechanism, but to really weight the portfolio so you end up with a more diversified exposure. You know, we know that cap weighting is a way to measure the market. It may not be the best investment solution because of the concentration that it can drive in either certain stocks or sectors, and that's where volatility weighting can really help smooth out the exposure of an index and provide a more balanced outcome.
So give me specific on what is volatility weighting? Is that the measurement of how much an individual security would go up and down? Is that okay?
Right, so the measure we use is the last 180 trading days of standard deviation, so price volatility.
Yeah.
So we begin with selecting only profitable companies. Once those profitable companies are selected, you pick the 500 largest in any given asset class, so you're still true to the cap profile you're trying to drive, and then you just weight them based on their volatility. So what happens is the shifts are subtle at the end of the day. You know, a stock that maybe has a 7.5% standard deviation may end up with a 0.4 weight in theory, versus one that has a 30% standard deviation over the last 180 trading days might end up with a 0.1 weight.
Right.
So they're very subtle tilts, but it ends up better diversifying an index so you don't have your performance or risk dominated by one security or sector.
Sure, and when you take, for example, the S&P 500, and the largest weighted security being 300 times that of the smallest security, and no rating regarding volatility, it seems like that might be a good strategy.
Right, and when we were building portfolios, you know, prior to joining Victory Capital, I was an investment consultant and evaluating managers, and you always look to diversify your risk and exposure. And cap weighting doesn't do that for you. So what happens is, with volatility weighting, you have the benefit of being able to benefit from the price movement of all those companies, putting them on equal risk footing. Whereas, you know, with a cap-weighted index, you're right, your performance could be dominated by one particular security. If you look at 2015, for example, the FANG stocks, for example, did really well. And if you look at the S&P 500, the slight positive performance was really the function of a handful of stocks. So somebody saying, I'm actually getting exposure to the entire market, that wasn't the case. And what cap weighting did in a year like that is create a false sense of diversification.
Right, absolutely. Well, indexing just keeps getting better. Thanks for your contribution, Mannik, and I look forward to hearing more from Victory.
Well, thank you for taking the time today.
Thank you.
Appreciate it.